Have you ever entered a Forex trade only to watch the market reverse immediately? Or maybe you've wondered why price keeps bouncing from the same areas over and over again. Well, that's not a coincidence. Professional traders don't just buy or sell randomly. They pay close attention to specific price levels where buyers and sellers consistently battle for control. These areas are called support and resistance, and they are among the most important concepts every Forex trader should understand. The good news? You don't need expensive indicators or complicated software to use them. In today's video, I'll show you what support and resistance are, why they matter, how to identify them correctly, and how you can use them to improve your trading decisions. By the end of this lesson, you'll be able to look at a Forex chart with much more confidence. So let's get started. Welcome to Build Smart Afri, your home for beginner-friendly tutorials on Forex trading, AI, technology, and online business. Our goal is simple: to help you build practical digital skills that can create real opportunities. If you're new here, don't forget to subscribe and turn on the notification bell so you never miss our weekly educational videos. Now, let's dive into today's lesson. What is support and resistance? Imagine you're throwing a rubber ball onto the floor. Every time it hits the ground, it bounces back upward. Now, imagine throwing the same ball toward the ceiling. It touches the ceiling and bounces back downward. Forex prices behave in a very similar way. Instead of a floor and a ceiling, the market has certain price areas where movements often slow down, stop, or reverse. These areas are known as support and resistance. Think of them as invisible walls created by the constant battle between buyers and sellers. Understanding these invisible walls is one of the first steps toward reading a Forex chart like a professional trader. What is support? Let's begin with support. Support is a price area where the market tends to stop falling because buyers become more interested in buying. As price drops, sellers initially dominate the market. But eventually, the price reaches a level that many traders consider attractive. Buyers begin entering the market. Demand starts increasing. Selling pressure weakens. The result? The price often bounces upward. Think of support as the floor beneath the market. Just as the floor prevents a ball from falling through the ground, support often prevents price from continuing lower. Of course, support isn't unbreakable. Sometimes sellers become so strong that price breaks below support and continues falling. That's why traders always wait for confirmation before entering a trade. Practical example of support. Let's look at a simple example. Imagine the EUR-USD currency pair falls from 1.1200 down to 1.1000. Each time the price reaches around 1.1000, buyers step in and push the market back upward. This happens once, twice, 3 times. Now traders begin recognizing something important. Every time price reaches that area, buyers appear. That means 1.1000 has become a strong support level. Professional traders pay close attention whenever price returns to that area because history suggests buyers may become active again. Notice something important. Support isn't an exact line. It's usually a small price zone where buying pressure becomes stronger. That's why experienced traders draw support as an area rather than a single thin line. What is resistance? Now let's look at the opposite concept. Resistance is a price area where the market often stops rising because sellers become more active. Imagine price has been climbing steadily. Buyers have been in control for hours, or maybe even days. Eventually, the market reaches a level where many traders decide it's time to sell. Supply increases. Buying pressure weakens. The upward movement slows. Price begins falling. That's resistance. If support is the floor, resistance is the ceiling. It represents an area where upward movements frequently struggle to continue. But just like support, resistance isn't permanent. If enough buyers enter the market, price can break above resistance and continue moving higher. Real-life example of resistance. Suppose GBP/USD rises from 1.2500 to 1.2700. Every time price reaches around 1,2700, sellers appear and push the market back down. After seeing this happen several times, traders begin marking 1,2700 as an important resistance zone. Whenever price approaches this area again, experienced traders become more cautious. Some prepare to sell. Others wait to see if buyers are finally strong enough to break through. This constant battle between buyers and sellers is what creates support and resistance across every financial market. Why do support and resistance form? This is one of the biggest questions beginners ask. Why does price keep reacting at the same places? The answer lies in human psychology. Markets are driven by people. People remember prices. If thousands of traders previously bought EUR/USD around 1,100 and made profits, many of them will want to buy again when price returns to that same area. At the same time, traders who missed the previous move may also decide to enter there. That creates increased buying pressure. The same thing happens with resistance. If many traders previously sold around a certain level and made money, they'll often try to sell there again. Because thousands of traders around the world are watching similar price levels, these areas become self-reinforcing. It's not magic. It's simply collective human behavior reflected on a price chart. Why are support and resistance so important? Now that you understand what support and resistance are, let's talk about why almost every professional trader pays close attention to them. The truth is, support and resistance are much more than simple lines on a chart. They help traders answer one very important question. Where is the market most likely to react next? No one can predict the future with 100% certainty. But successful traders don't try to predict every move. Instead, they look for areas where the probability of a reaction is higher. That's exactly what support and resistance provide. Let's look at some of the biggest advantages. 1. They help you find better trade entries. One of the biggest mistakes beginners make is chasing the market. Imagine EUR/USD has already moved up over 150 pips. Many new traders see the big green candles and immediately think, I don't want to miss out, so they buy at the top. Unfortunately, that's often where experienced traders are taking profits. A few minutes later, the market pulls back. The beginner panics. Their trade goes into loss almost immediately. Professional traders think differently. Instead of chasing price, they wait patiently for the market to return to an important support level before looking for buying opportunities. Why? Because buying near support usually offers a better price and reduces unnecessary risk. Patience often separates profitable traders from emotional traders. 2. They help you place better stop losses. Let's talk about stop losses. Many beginners place their stop loss almost randomly. Some use 5 pips, others use 10. Some don't use 1 at all, which is extremely risky. Professional traders often use support and resistance to decide where a stop loss should go. Imagine you've bought EUR/USD at a strong support zone. Would you place your stop loss inside that support area? Probably not. Small price fluctuations could stop you out before the market moves in your favor. Instead, experienced traders usually place the stop loss slightly below the support zone. This gives the trade enough room to breathe while still protecting their capital if the setup fails. The same principle applies when selling near resistance. The stop loss is often placed slightly above the resistance area. This approach is based on market structure instead of guesswork. 3. They help you set realistic take-profit targets. Now let's talk about exits. Knowing where to enter is important, but knowing where to exit is just as important. Suppose you buy EUR/USD at support. Where might price struggle to continue rising? The answer is often the next resistance level. That's why many traders use resistance as a potential take-profit target. Likewise, if you're selling from resistance, the next support level may become your profit target. Instead of choosing random numbers, you're allowing the chart itself to guide your decision. This creates a much more structured trading plan. 4. They reveal market psychology. Here's something many beginners don't realize. Every candlestick on your chart represents thousands or even millions of decisions made by traders around the world. Banks, investment firms, institutions, retail traders. Everyone is reacting to price. Support and resistance exist because people tend to behave in similar ways. Imagine you bought EUR/USD at 1.1 thousand last month and made a great profit. When price returns to that same level, what are you likely to think? This worked before, maybe it'll work again. Now imagine thousands of other traders are thinking exactly the same thing. That's how support becomes stronger. The same psychology applies to resistance. The market is simply a reflection of human emotions: fear, greed, confidence, and uncertainty. Once you understand that, price movements begin to make much more sense. 5. They improve risk management. One of the biggest goals in trading is to protect your money. Professional traders know they won't win every trade. Instead, they focus on managing risk. Support and resistance make this much easier. Imagine you're risking 30 pips to potentially make 90 pips. That's a 3-to-1 reward-to-risk ratio. Even if you win only half of your trades, you can still be profitable over time. Without clear support and resistance levels, it's much harder to define your risk and reward before entering a trade. That's why experienced traders always plan their trades before clicking the buy or sell button. 6. They work on every time frame. Another great thing about support and resistance is that they aren't limited to one trading style. Whether you're a scalper trading on the 5-minute chart, day trader using the 15-minute or 1-hour chart, swing trader on the 4-hour chart, or long-term investor using the weekly chart, support and resistance remain relevant. The only difference is the strength of the level. Generally speaking, support and resistance found on higher time frames tend to be more significant because more traders are watching those areas. That's why many professionals begin their analysis on the daily or 4-hour chart before moving to lower time frames for trade entries. This top-down approach helps them see the bigger picture. 7. They help confirm other trading strategies. Support and resistance become even more powerful when combined with other forms of analysis. For example, imagine price reaches a strong support zone. At the same time, a bullish engulfing candlestick pattern appears. The relative strength index also shows the market is oversold. Now you have multiple pieces of evidence suggesting buyers may take control. This is called confluence. Professional traders rarely rely on just one signal. Instead, they look for several factors pointing in the same direction before entering a trade. The more confirmation you have, the stronger your trading decision becomes. If you found this video helpful, please give it a thumbs up, subscribe to Build Smart Afri, and turn on the notification bell so you never miss our upcoming Forex tutorials. And that's it for today's lesson. I hope you now have a much clearer understanding of what support and resistance are, and how they can help you make smarter trading decisions. Remember, successful trading isn't about predicting the market perfectly. It's about understanding how price behaves and making disciplined decisions based on high-probability setups. I'd also love to hear from you. Leave a comment below and tell me, what's the biggest challenge you're facing in Forex trading right now? Your question might even inspire our next video. For more beginner-friendly guides on Forex trading, AI, technology, and online business, visit buildsmartafri.com, where you'll find in-depth articles, practical tips, and free learning resources. Thanks so much for watching. Stay disciplined, keep learning, manage your risk wisely, and I'll see you in the next video. Happy trading!